Financial markets in turmoil.
What are the root causes of the financial crisis?
The dollar losing value.
Heading for its biggest loss in nearly 3 decades.
Will Social Security even be there?
I don't know.
Buy or rent?
That's a very good question.
Interest rates.
I'm not so sure.
Where do you put your money?
I don't know.
Welcome to the show that answers your questions. This is Follow the Money Weekly with your host, economist, and best-selling author. Here's Jerry Robinson.
Friends, welcome to you all around the world. Welcome to Follow the Money Radio. So grateful to have you along for the ride today. We do have a good show for you today. We're going to be talking about 3 trading strategies that work. We're going to be talking about 3 trading strategies that work. I'm going to share, a couple of ideas here that in this current environment where we are, where the stock market has been just a wild ride. Remember what we saw in February, where the market just literally cratered. And it was to be expected when the entire economy got shut down. There was a fear over this current public health crisis. It shocked the markets, and they came tumbling down very quickly until the Federal Reserve stepped right in to prop up the market. If you think about this stock market today and you thought to yourself, what if the Fed decided to go ahead and pull the plug? Maybe the Fed said, we've done a pretty good job. We've pumped in trillions of dollars and we have interest rates at 0 now. And apparently everything is improving according to Washington. And so if that's the case, then perhaps we should pull the plug and maybe stop pumping in trillions of dollars. And maybe we should stop buying, recently downgraded junk bonds and bailing out junk bond investors. What do you think would happen to the stock market rally right now? How much of the stock market rally do you think is being propped up by the Fed, and how much of it is actually being pumped up by the fundamentals? I think the answer is pretty clear. So the market has been running clearly on Fed stimulus, Federal Reserve stimulus. That is, they printed money and they bailed out Wall Street, just like they always do. So the stock market is now rebounding. And in fact, this week, as we do this podcast, the S&P 500, which is probably the most important index for those of you who trade U.S. stocks, and for those of you even who are not in the United States but look at the United States stock market as a place to trade, the S&P 500 index is by far the benchmark, if you will, for the U.S. stock market. Now, there's other ways that you can look at the NASDAQ if you're tracking tech stocks, or the Russell 2000 if you're focused upon small cap stocks. But the S&P 500 is, the pretty big juggernaut here in the United States. And the reason why I bring up the S&P 500 is because we watch it for our members. We watch it for ourselves as traders and investors as well. And just this week, we have moved back to the 200-day moving average line on the daily chart. Now, if you're not familiar with the 200-day moving average, it's a very important line that can be drawn on any chart. In the old days, you had to hand draw charts, but today with computers and with the internet, you can simply add a 200-day moving average line. And what a 200-day moving average line is a smoothed out average of all of the closing prices of the S&P 500 for the last, in this case, 200 days. And whenever you take that number and you smooth it out, you get an average. And that average becomes extremely important for traders like myself, and for many of you, also for investors, because it becomes almost like a dividing line, a line in the sand. Many people, in fact, who are well-known investors have publicly stated that the 200-day moving average is literally what they watch. We know that many CTAs, or commodity trading advisors, as well as hedge funds and trading bots and all of these different outfits that trade in the markets, many of them greatly depend upon the 200-day moving average line. And when a stock pierces above that line, then you will see many people, many investors and traders will turn bullish on that particular stock or ETF or index. And then whenever that line is breached to the downside, it can often be a sell signal. One of the greatest traders of our generation, Paul Tudor Jones, has often said that he avoids stocks that trade below their 200-day moving average, and he buys stocks that are above their 200-day moving average. It seems very simple, but it's really quite powerful. So the S&P 500 made it up to the 200-day moving average, I should say, this week, and we will see how things go. Whether we're actually able to close above that area. So closely watching that right now. But when you look at the overall market, the NASDAQ has really been where it's at. That market has really continued to rebound here, even nearing a new all-time high, if you can believe it, in this environment. Also, gold has been a big winner here. Gold has really been been on an uptrend now for some time. And speaking of gold, later on today's podcast, Tom Cloud will share his take on why gold prices are not rising faster in this current environment. We've had some questions about that because gold's been in an uptrend now for many months. And we've called that a long time ago, and we remain bullish on gold. But some people are wondering, why isn't gold going up quicker? I mean, you have the Fed literally printing, up to 5.5 trillion, I think is the actual number that they're allowed to print, or they have said they will print. And so with that kind of craziness, and also with all the other uncertainties, and with central banks buying gold, some investors are wondering why gold isn't going up faster. So Tom will be here to answer that question, also to provide an update on silver. So we'll talk about that soon. Silver also beginning to show some strength here after a very long slumber. We called our new position uptrend on silver a couple of weeks ago for our members. I guess about 2 weeks ago. And we've also seen a very impressive rebound in oil prices. Oil prices, which were negative 40, you may recall, have really rebounded quite substantially since their recent lows. So all of that being said, we look at the stock market, we see a lot going on. And what I want to do today is I want to provide those of you who are traders, new traders, maybe you're a novice, maybe you've been trading for some time. What I want to do is I want to share with you 3 different strategies that really work if you're looking to trade the markets. And let's just go through them briefly for the sake of time, because I want to get a few more items in this podcast today. So the very first strategy that works in the stock market is known as swing trading. And I'm going to talk a little more in depth about swing trading itself. The strategy, of course, that you could actually call swing trading a style, maybe not a strategy, but a style. But I'm going to talk about strategies attached to each one of these styles. And the style of swing trading is a very powerful trading style for those who don't want to have to sit in front of their computer as a day trader and watch their stocks all the time. It's great for individuals who, they work during the day, they have access maybe to their phone so they can check their stocks a few times a day, but they have other things going on and they don't want to be sitting in front of the computer all day. So swing trading is a very powerful strategy that works, that people every single day, people just like you and me, take money and they look for stocks that are entering a potential new swing uptrend, is what we call it here at Follow the Money. They look for those types of trends to develop, and then they will buy. And what we teach our members to do is to scale in even to your swing trades, because you want to be careful not to put all of your money into any one position just immediately, especially when a stock is beginning to curl up, it's beginning to form a new uptrend perhaps on the daily chart. You want to be careful not to just jump all in and start, put all your money into it. You want to slowly kind of leg into those positions. And that's what we teach our members here. We also teach that through our trend trading boot camp, which we do a few times a year online. So the swing trading strategy in style is very, very powerful. And one of the most simple ways that swing traders identify new opportunities is they look for stocks that are already above their 200-day moving average. And they wait for the first 1 or 2 pullbacks to the 50-day moving average on the chart. So again, if you're not familiar with some of this language, it's very simple. You can go to a stock chart online. You can go to stockcharts.com, or you can go to finviz.com. There's many different charting softwares out there that you can use. We have our own here, followthemoney.com. But you can get or even Yahoo Finance, and you'll notice that you can add on moving averages. Well, what individuals will do is they'll wait for a stock that's above a 200-day moving average, maybe that's been kind of running higher, they wait for it to pull back to its 50-day moving average. And then once it touches the 50-day moving average, they'll look for what we call a 50-day moving average bounce. And when that bounce occurs, when it begins to curl back up, that is where the swing trader will often buy. Now, that's just one strategy that works. There's several different swing trading strategies, but that's one of them. And so you're looking for uptrending stocks that are already above their 200-day moving average. They run nicely, but then they pull back to their 50-day moving average, and then they tend to bounce off of that area. You'll find a lot of support at the 50-day moving average for a current uptrend. And so, historically, if you look at the work of, for example, somebody like William J. O'Neill, who runs Investors Business Daily, he's a very popular investor, well-known trader as well. Through his research, he's discovered that after a stock breaks out above its 200-day moving average, it'll tend to pull back to its 50 2 to 3 times before it begins to exhaust the uptrend. Sometimes it happens many more times. I've seen stocks, touch their 50-day moving average and run, and then do that 4, 5, 6, 7, 8, 9, 10 times before it finally gives up. But from his research, he discovered that, usually the first 1, 2, maybe up to 3 touches are usually pretty high probability that you're going to get another rally out of that stock. So swing trading is very powerful. The strategy that you can use here is a 50-day moving average bounce. That's what we call it. It's a very simple strategy that anyone can learn. And every single day for all of our members, by the way, we put out a new swing trading idea. So we do a lot of the heavy lifting for many of our members. That's what they enjoy about being a member here, is that we are looking through the stock market every single day, and we're identifying every stock or ETF that is currently forming what we call a new swing uptrend. And swing traders look for swing uptrends. They look for new trends that develop on the daily chart that they can jump in and earn. And what are swing traders looking for? To me, 1 to 5% in 1 to 5 days is a really fantastic swing trade, but you can often make more. I mean, many times with our swing trades, we may, make 10 to 15, even sometimes 20% on a swing trade. Now that's, you don't want to plan on that every single time, but usually I say 1 to 5% in 1 to 5 days. That's a really fantastic return. Just think about what people are earning in the banks right now. You take your money down to the bank and you put it into a CD or something. I mean, if you make 1% in a year, you've really done something, right? 1% in a year. So what I just said was that if you can earn 1 to 5% in 1 to 5 days, right? That's extremely powerful in this zero interest rate world, isn't it? So swing trading has its place, and it can be a really fantastic income stream for people who have a little bit of time to focus and learn and commit themselves to learning a new trade, learning a new skill. And it's fantastic. So we put out a daily swing trading idea for all of our members. Silver, gold, platinum, they all receive our daily trading idea. It's a swing trading idea. And we even mention in the swing trading idea every day that we send out by text and or email to our members what the entry price would technically be. So what would the trigger price be? Where would you actually buy that stock? And then we also add a stop loss price so that you're able to see, where should I just bail on the stock? Where would I bail on the stock, if it began to go down? Because not every single swing uptrend necessarily materializes, right? Sometimes a stock will look like it's going to go higher, or an ETF will look like it's going to go higher, and then it fails. Well, that's okay. That's okay. As long as you cut your losses short, as long as you scale into your trades and you don't over leverage yourself initially, and you just scale in as the stock begins to move higher, then you'll be completely fine. In fact, bringing up Paul Tudor Jones again, he explained that if you're just right 3 or 4 times out of 10, you can make a lot of money in the market if you cut your losses short. That is, if you don't sit in stocks that keep going down. You have a stop loss. That is an order that automatically executes at a certain price if it falls. That way you get out of the trade. And that's really important for swing traders, especially if you're not watching your stocks all day long. You're maybe working and then you're checking your stocks. You've got to have a stop loss order placed upon your trades. We also put out, as I mentioned, every night we scan the entire market. We've been doing this now for years, and our members greatly appreciate this, but we scan the entire market and we look for every single new swing uptrend, and we list those on our website on our nightly trading alerts page. So our members get access to that. So swing trading, the number one trading style, and as far as the strategy you could use here, you could use a new swing uptrend, which we have created through our own software. You can look for a 50-day moving average bounce. That's another strategy that you can use with swing trading. Wait for that stock after it's above its 200-day moving average to pull back to its 50, and look for the first 2 or 3 bounces there to potentially provide nice short-term gains with a goal of 1 to 5% in 1 to 5 days, maybe more, and oftentimes more. But keep your expectations within reason. One of the problems that many traders have is they set their expectations too high. They might see something on YouTube or on television, or they might see something on Twitter, and they might think, well, I have to make 100% on every trade. I got to swing for the fences. And these are the people who tend to lose a lot of money in the market because they're always taking on excessive amounts of risk. You got to keep your risk low. Low risk setups are what we really like. So the number one strategy here, swing trading using some of these different strategies that we had mentioned. The second style that I want to bring up is something called position trading. And the strategy that we use with position trading, there's several different strategies that we can use, but the one I want to highlight for today's podcast is very simple. It's the 200-day moving average breakout, the price breakout. So let's talk about position trading just for a minute. So I've been a position trader now for many, many years. I've been trading for more than 20 years. Traded my first stock in 1996, traded my first option in 2002, bought my first cryptocurrency in 2012. So I've been trading the markets now for many years, and position trading is just generally what I find myself. It's like my saddle. It's like it's perfect style for me, as my schedule and my calendar sometimes can be pretty hectic. It makes it very good for me because what position trading does, or what the style entails, is buying a stock and then enjoying the majority of its uptrend. So as a stock enters a new major uptrend, then you buy it and you just sit and you sit, maybe sometimes for weeks. Usually, and with my position trades, I usually sit for months. And so it's a much larger gain than what you would receive from a swing trade. So with usually with the position trade, I expect 20% gain. And, as far as how long it might take, it might come in a few weeks, but it tends to take a few months. And I'm happy with that. Again, because if you can earn 20% in a matter of a few months, again, versus putting your money in the bank and earning practically zero for the whole year, you can see how this is, this is a particularly powerful strategy that people can use. Now, again, how do you take position trading and what strategy would you use? Well, the one I want to talk about simply on this podcast is the 200-day moving average breakout, which occurs whenever the stock price comes up from below the 200-day moving average line and pierces above it. And when you get a piercing above the 200-day moving average, especially on higher than normal volume, that's really key, then that can be a stock that you can then look for an entry on and then add it and then potentially hold that as it rises and then maybe bounces off of that 50-day moving average a few times, just like the swing trader, he's looking for that. Well, you can, as a position trader, you would actually be owning that stock as it runs higher above the 200-day moving average and then pulls back a few times to the 50-day moving average. Again, that's where the swing trader would enter, but that would be a stock that you would be holding as a position trader. So the 200-day moving average breakout strategy is absolutely fundamental, and there's a lot of moving parts to it. And we have in our store right now, you can go to followthemoney.com/shop, and there you'll find we have a 200-day moving average strategy that we have right there in the store, and you can buy that. It comes with a PDF slide deck. It comes with a video that, it's about an hour-long video that explains the entire strategy. And it's on sale right now. So I would strongly recommend, if you're looking for a strategy that's going to work for you and position trading sounds good to you, then this is a fantastic strategy to learn. And it's just like anything else. You just like learn how to ride a bike. You learn how to trade. And there's not really a shortcut to it. You've got to learn the right way, and you've got to practice over and over, and you'll get better. And that's how trading works. That's how every skill works. So for those of you who are interested in position trading, again, a longer term, you don't have to look at your stocks nearly as often. Of course, you want to check them at least once a week. But I tend to hold my positions, have that stop loss in place, and check my stocks on a regular basis, and just tend to sit and hold and enjoy those uptrends while they last. And then whenever they begin to look like they're topping out, that's whenever I begin to take gains. And we explain all of that in our new video course, as I've stated, that brand new course on the 200-day moving average strategy. So if that's something that you're interested in, go check that out. followthemoney.com/shop. Also, our platinum members have access to our private Twitter feed. And, anytime I enter a new position trade, I will just alert our members there so they can actually see what I'm doing. Sometimes people learn best by just watching others, and that's very powerful. We also list all of the new position uptrends that are forming in the U.S. stock market, whether it's stocks or ETFs, on our website every day for our members in our nightly trading alerts. So that's the second trading style, and the strategy, of course, is the 200-day moving average. Let's review real quickly. We have swing trading. That's a great style. That's good for people who want to hold a stock for just a handful of days, maybe up to a couple of weeks. They don't have a lot of time to look at their computer every single moment of the day, and that's a great style. And one of the great strategies that you can use with that is the 50-day moving average bounce. When this price pulls back to the 50 above the 200 and it curls back up, that's the buy point. The second style is position trading. And again, the strategy we use with that, there's many different strategies, but one strategy we'll share on this podcast is the 200-day moving average price breakout. And as we mentioned, as the price breaks out above that area, especially on higher than normal volume, that can be a really good opportunity to look at the stock and see if there's a new trend that's developing. And of course, the 200-day moving average strategy course we have on our website. You can check that out if you're interested. Now, the third and final trading style that I want to introduce you to is something we would call day trading, right? And of course, everybody knows what that is. And if you have more time on your hands, many people are sitting home right now because they don't have a job, or maybe their job is on furlough, or whatever the case might be. Some people have more time on their hands today. And so maybe this might be a more appropriate time for some people to day trade. So I've day traded. That's something I've certainly done. In fact, in the late 1990s, that's exactly how I cut my teeth in trading, was primarily day trading. Well, one of the strategies that you can use that I think is particularly powerful is what we call trading the open. This is the strategy that I want to talk about here in this third style, and that is buying the open. So typically, for those of you who are familiar with our work, we tend to shy away from trading stocks in the first 30 minutes of the day. And the reason why is because there tends to be a tremendous amount of extra volatility there, and you oftentimes won't get the very best entry price that you could at other times. I much prefer the last 30 minutes to the first 30 minutes of the market. In fact, many people even call that very first 30 minutes the amateur hour. And then the last 30 is kind of whenever the big heavy hitters tend to step into the market. And you can certainly see that from all the volume that comes in the last 30 minutes in the market, especially like the last 5 minutes of the market session. Now, having said that, even though we tend to shy away from trading the open, there is a particular trading the open strategy that we do like. And while I don't have time to get fully into it here, I just want to kind of scratch the surface on it. It's a really simple strategy, but there's quite a bit to it. In essence, what it is that whenever the market opens, what you do is you look at the price for the very first, and you can choose either a 15-minute window or a 30-minute window. We teach our members both ways, and this is a very powerful strategy for day trading. So whenever the market opens up, maybe you're watching a stock, maybe you're trading the S&P 500 or the NASDAQ index, or maybe you're trading a stock like Tesla or 3M, or maybe you're trading Microsoft, who knows? Whatever your particular stock that you're looking at, whatever your niche is, your trading niche, what you're looking for is that stock to, of course, rise in the first 15 to 30 minutes. And for the sake of this podcast, let's assume we're going to look at the first 30 minutes. So we look at the very high price during the first 30 minutes. let's use an example. Let's say that Microsoft opened up, and let's say Microsoft is trading for, in this imaginary scenario, let's say it's trading for $50. Okay, that's not true, but let's just say it's trading for $50. Okay, so it opens up and it's trading for $50. Now, during the first 30 minutes, it goes up to $50.50. That's the high that's set during the first 30 minutes. Okay, so once we have that first 30 minutes of data, we know that the high price reached during the first 30 minutes was $50.50. So what this strategy does is it places a buy order to buy whenever the price goes above that 30-minute high, that first 30-minute high, by 2 cents. So in essence, if the stock goes to $50.52, then you buy. And you can set that up as an automatic buy order that you can just kind of walk away and not forget about it, which I wouldn't recommend. Or you can, watch the stock because it is a day trade, and you can enter right at $50.52. And then your goal is to liquidate that position before the end of the day. The reason why this is such a powerful strategy is because oftentimes in this current market, you'll see that the market powers higher and then just kind of keeps powering higher for a few hours and then just kind of stays there, right? Maybe sometimes curls down towards the end of the day. So on big bullish days, you can capture some of that good upside using this day trading strategy. And then where do you put your stop loss? Well, your stop loss goes at the bottom of the first 30-minute candle. Now, clearly, there's a lot of moving parts there that you want to think about. But this trade the open strategy has been one of several very successful strategies that our members have used over the last several years to profit from the market. And so these three strategies, swing trading using the 50-day moving average bounce as an entry, position trading using the 200-day moving average breakout as a strategy, entry strategy, and then trading the open as a day trader, buying the break above the first 30-minute high, 2 cents above it. These three have been very powerful for our members. And it's something that if you're out there and you're saying, I'd like to learn how to trade, I'd like to learn how to do some of these things, but some of this, I need a teacher, I need somebody to help. Well, you're in luck, because that's exactly what we do here at Follow the Money. We are educators here to help you understand how you can make money, not just from the market, but from real estate and from many other things. We have lots of things for our members, so many resources for our members at followthemoney.com. But here you can see three different trading strategies that work. They work because we know they work. We use them personally, and we have members who use these strategies. And it's a very powerful way to generate income in your life. So I hope these were very helpful to you, these three trading strategies that anyone can use, especially once you have got the educational foundation that you need. It can be very powerful. It'd be a new income stream in your life. Right now, many people need a new income stream. They've lost a job. Maybe their spouse has lost a job or something. This can kind of fill the gaps. This can kind of help in these times of crisis. And of course, you would never want to use your rent money or your mortgage money to trade. This is only risk capital that you would use. But nevertheless, it can be a fantastic way to raise money right now in the middle of a very tumultuous time. Hey friends, Jerry Robinson here. I hope you enjoyed that first segment today about trading strategies. Again, let me urge you, if you are interested in learning our 200-day moving average strategy, we have just created a brand new video course that you can check out. It's on sale right now in our online store. Go to followthemoney.com/shop, and you can learn all about how you can get access to that course, that video course with a PDF slide deck that comes right along with it. You'll be able to learn a brand new strategy to begin making money in this market. So just go to followthemoney.com/shop and see the growing number of resources that we're making available for investors and traders just like you.
Follow the Money Weekly presents your precious metals market update. Here's Tom Cloud.
Hello, this is Tom Cloud with my bi-weekly precious metals update for FTM listeners. I had several letters this time, and one of them in particular needs to be addressed because we need to know what expectations are when I say things, and I don't sometimes elaborate on them enough to where you know. So the first question that came in is that I've been talking about the central banks increasing their buying for a year, and that's definitely true. And the person sending the question says, why isn't gold going up faster since central banks are buying? Investors seem to have picked up a little bit. What's going on in that world? So what I want to do is I went back and looked at some numbers as to when in January of 2019, a year and 5 months ago. Since then, gold has gone up 35% in 12 months plus 5, 17 months. It's gone up 35% since the central banks increased their buying in January 2019. On the flip side of that, during that 19 months, the gold's gone up 35%. Stock market's gone up 7%, and that includes yesterday when it had a 3% day. So we're still, after 17 months, gold's up 35%, 2% a month, and the stock market's up 7% total. Since January the 1st of 2020, this will lead into the next question, gold is up 13%, while the Dow is down 3%. So there's a 16% difference in only 5 months on there. So gold continues to average over 2% a month since the central bank started buying heavily. And I don't know how in the world anyone could expect more. And I'm not being smart aleck. I just don't know what you expect when you see a market moving. It's kind of like the tortoise and the hare. Gold is the tortoise. Silver will be the hare at some point. It's not right now. And we'll discuss that in a second. So hopefully you can see that until gold gets to 2,500 or 3,000, I think it's going to keep averaging at least 2% a month. There'll be months it goes down maybe a little bit, months it goes up 3%, but you can just keep looking because that steadiness of central banks buying gold and taking those 400-ounce commercial bars out of the market for individual use. I mean, it is an amazing time. Gold should be your number one foundation. If you look at a pyramid and you go up, people like to put stocks as the most, bonds as the next most, cash, real estate, foreign currency, and gold and silver right at the tip, just a little bit. But it's almost like inverted right now. It should be the opposite, seriously. Gold should be your foundation. Nobody can create out of thin air like the U.S. government is currently doing. We're printing trillions of dollars for everything from Social Security to unemployment to stimulus packages. And the stimulus packages don't even go to the coronavirus people. It goes to everything you can think of. Just look at it. And this newest bill that Nancy Pelosi sent over, passed through, I mean, I can't imagine one congressman voting for that. And yet almost all of them did. But please go look at where the money's going. I don't think it'll make it through the Senate, but if it did, look where the money's going. It's not going for coronavirus things, except a little bit. It's going for everything else you can think of, pork belly type needs. So anyway, we look at that. Now it leads into the next question. So I hope you as listeners understand gold is not going to slow down. You're creating so much paper money that inflation will come back. Right now, unemployment is so high, people are still out of work. Yeah, once they come back and the money starts going through the system and has velocity, you're going to see higher interest rates and you're going to see higher inflation. You're going to see much higher gold. Let's move over to silver. Silver has, people say, why does it keep sticking around and doing nothing? I've said many times on this show, right now, we're in a depression. we're not in a recession, we're in a depression. So the industrial demand for silver has slowed. It's not like gold that can be used on balance sheets by central banks. Silver cannot. You can't count dollar for dollar. Even the central banks are telling you dollar that gold is the number one thing to own because that's what they own. So you look at silver, and over the same 17 months that gold's gone from January the 1st, 2019 till now, a total of 17 months, gold up 35%, silver down 5%, down 5%. So you've got a 40% difference in gold and silver over the last 17 months. So does that mean you don't want silver? Absolutely not. I'm buying silver every month. A few $100s here, a few $100s there. I'm stockpiling ounces of silver. Why? Because I've been in this business 44 years. I've seen it all. I saw the 1976, the year I started this company, till 1980, 4 years, where silver went from $3 and change to 50, 17 times in 4 years. And then we moved forward to 2008, the financial crisis of 2008, when gold was going up just like now, silver was going down. It got down below 10. And from $9 and something, by the fall of 2012, in 4 years, silver was at 48. It went up 5.5, 6 times. So now we watch silver continually drop slowly, first quickly and then slowly continue to drop because of the uncertainty of investors staying out of an industrial metal area, investment opportunity. So now we see many things have changed. The two main things are Audi, Tesla, Chinese cars, all are moving to electric cars. Big drain on silver. But the biggest is the solar panels. State of Florida, I've mentioned, has already started making their commitment for the future for energy. Solar panels, reproduce clean energy, using the sun, using silver as the main reflector. So you look at this, and I can tell you, silver's going to go way past 50, where it's been up to twice. First in 1980, and then in 2012. The next time it goes, as this inflation kicks in from all this pork belly printing of money, even Trump, whether there's nobody being conservative. Everybody's out there trying to buy votes. The Democrats, Republicans, that's the way it works. But unfortunately this time, it's run the deficit numbers that can't, and the US dollar will not survive. I can promise you it will collapse. There's no question about it. It's just, where will your money be when it does? And that's what you got to do. That's your homework. Not just metals. I'm talking about you're not going to put all your money in metals. I don't. I wouldn't expect you to. But I do expect you to have a good portion in it. And now that things are getting back, premiums are coming down. It's a great time to be adding and cost averaging. If you don't have any, you need to decide and talk to your financial advisor. But most of them don't have a clue. They know about stocks and bonds and cash, but why haven't they had you in gold if you're not in gold the last 17 months? If they had your best interest at heart, and I do a lot of business with financial advisors. There's never a week goes by I don't get calls saying, what's up? Tell me what's happening. What should I do with these investors? I'm talking about having personal gold, physical gold. Store it, and if you haven't heard, we have the lowest storage in the world. Can you believe that? In the world. The lowest storage fees. They're so low I can't even talk about them on the air. But give us a call at 800-247-2812 and we can discuss it with you. And but remember, if you're buying an ETF, you have paper gold or paper silver, not real. So hopefully we've gone through and answered these two main questions. Silver's down 5% this year while gold's up 13%. There's an 18% difference. Who would have thought I could have come to you the last week of May 2020 and tell you, hey, would you like to buy a silver January 1st, 2020 prices? You'd say, yeah, count me in for $500 $5,000, $50,000, $500,000. We just had a silver sale for over $500,000. It was just to bring to where the percentage of what they wanted, they had the gold but not the silver. So you've got to do that. And then what continues to be the fastest growing part of our business are the self-directed precious metals IRA. People are, hundreds of thousands of baby boomers every month are retiring. They're taking their money from their 401k and they're creating two self-directed IRAs. One to keep their stocks and bonds going in cash, and one for precious metals. They are physical precious metals. So, we can be we cannot be your custodian, we can be your broker and your representative, but we will help you get a custodian that you have to have. But call Dan or I at 800-247-2812 to do that. And hopefully next week, keep the questions, but we did need to hit the two big boys and why they have such a huge discrepancy. And silver may not accelerate for a few more months until the velocity of money and inflation picks up and all this stimulus is piling in, running our deficit through the roof. As I've said before, the biggest debt this country's ever had in 1 year was $1.7 trillion. We're going to be between 4 and 6 trillion for this one fiscal year that ends September 30th. So get your money in the right place. Keep doing your research for alternative investments. But I can tell you, stock market, as I said, is up 7% since January of 19, and gold is up 35, 135, and all you hear about is how great stocks are. They're fine. I've got money in stocks, but just get diversified before it's too late. So hopefully keep the questions coming. Keep praying, and thank you for all the nice comments. We had several of you that sent about my wife and I having our 50th anniversary last week, and we appreciate it. She has been there right there beside me for 50 years of building this company, raising kids, now 4 grandkids, and we just thank you for the support. And if we have any other questions we can answer, give us a call. With this week's bi-weekly Precious Metals Update, this is Tom Cloud signing in.
Hey friends, this is Jerry Robinson from Follow the Money Weekly. Recently, we have been receiving many emails from our listeners commenting on the great help they're getting from our precious metals expert, Tom Cloud. Gold and silver are excellent hedges against the growing threat of coming U.S. inflation. Who's your gold guy? Make it Tom Cloud. With over 30 years experience with precious metals, Tom will answer all of your questions. Don't buy your gold and silver through some call center and pay inflated prices. Call my good friend Tom Cloud and speak directly with him and get all of your questions answered. For a limited time, Tom is offering free shipping and insurance on every gold and silver purchase made by our listeners. Call 800-247-2812. And when you do, tell him that Jerry Robinson from Follow the Money Weekly sent you, and he'll throw in that free shipping and insurance on your entire order. Call your gold guy, Tom Cloud, right now for the very best deals on gold and silver coins. 800-247-2812. That is 800-247-2812.
All right, where's my money? Money. Daily bread.
Follow the Money Weekly presents the Retirement Minute.
Hello, everyone. This is John Burse with this week's Retirement Minute. April is Financial Literacy Month, so I decided to ask my attorney what the most important documents are that every adult-age person should have to make sure they protect their estate. Since I'm not an attorney and do not give legal advice, I thought I would take the month of April and share with you what he told me. So for the month of April, I'm going to talk about 5 important documents that you need to have. Last week, I talked about the first 2 important documents, having a will and a letter of instruction. So if you missed last week, you can go to the ftmdaily.com Retirement Minute Archives to catch up. This week, I will discuss the importance of an advance medical directive. Advance medical directives let others know what medical treatment you would want, or allow someone to make medical decisions for you in the event you can't express your wishes yourself. If you don't have an advance medical directive, medical care providers must prolong your life using artificial means if necessary. With today's technology, physicians can sustain you for days and weeks, if not months or even years. There are 3 types of advance medical directives, and each state allows only a certain type or maybe all 3 types. You may find that 1, 2, or all 3 types are necessary to carry out all of your wishes for medical treatment. So check with your state to make sure you know what is required. Just make sure all documents are consistent. The first type is a living will, which allows you to approve or decline certain types of medical care, even if you will die as a result of that choice. In most states, living wills take effect only under certain circumstances, such as terminal injury or illness. Generally, one can be used only to decline medical treatment that serves only to postpone the moment of death. In those states that do not allow living wills, you may still want to have one to serve as evidence of your wishes. The second type, a durable power of attorney for health care, which is also known as a health care proxy in some states. It allows you to appoint a representative to make medical decisions for you. You decide how much power your representative will or won't have. And then finally, the third type, a do not resuscitate order, is a doctor's order that tells medical personnel not to perform CPR if you go into cardiac arrest. There are 2 types of do not resuscitate orders. One is effective only while you are hospitalized. The other is used while you are outside the hospital. So make sure your financial house is in order.
Contact us at followthemoney.com/advice to be put in touch with a Christian financial advisor in your area. The Christian Advisor Referral on followthemoney.com. All right, friends, and that brings us to the end of our broadcast. Thank you so much for being a part of our broadcast every time we put one of these out. It sure is an honor to serve you all around the world. Don't ever hesitate to reach out to us as well. You can always reach out to us by email at info@followthemoney.com. If you have a comment or a question about one of the podcasts you've heard, we're more than happy to reach out back to you by email. Just send us an email, info@followthemoney.com. And as always, I like to leave you with a final word, this time taken from the book of Proverbs, chapter 11, verse 28, where it says, "Whoever trusts in his riches will fall, but the righteous will flourish like a green leaf." You know, it can often be a tough balancing act as you are making money, but not putting your trust in money. It can be a very challenging thing, but let me stress to you the importance of not putting your trust in money. It will never make you happy. It will never bring you true and lasting peace. Only the Prince of Peace can do that. And that's just something to think about. Remember, friends, when you want the truth about the global economy, just follow the money. Have a safe and prosperous week, and we'll see you right back here next time. Until then, God bless.
All of the information contained on the Follow the Money podcast is strictly for informational and educational purposes. It should not be construed as specific investment advice. The views and opinions of our guests and sponsors, including Tom Cloud, are their own and do not necessarily represent the views of ftmdaily.com or Robinson Media Group, LLC. Jerry Robinson does hold an insurance license and at times may offer consulting on life insurance and fixed retirement income products. Follow-up, individualized responses to email or phone requests that involve the rendering of personalized investment advice for compensation will not be made absent compliance with state investment advisor registration requirements or an applicable exemption or exclusion and applicable insurance regulations. Past performance is not indicative of future results. You should be aware of the real risk of loss in following any strategy or investment discussed on the podcast. Remember, never do your financial planning through podcast or radio. It's your money. Be wise. Do your due diligence and always consult a trusted financial professional before making any financial decisions.